Let's dive right in. We're talking about the single biggest challenge for investors in 2026. How in the world do you invest your money when it feels like everything is already at the peak of the mountain?
I mean, think about it. It is a real puzzle, isn't it? Stocks, gold, silver, real estate, even crypto, you name it, it's hitting an all-time high, and they're all doing it at the same time. This creates a ton of uncertainty. If everything's already expensive, where do you possibly find value? Or maybe more importantly, where do you find safety?
And just to put this into perspective, this is not normal. This is incredibly rare. In the last 100 years, we have only seen all major hard assets at an all-time high like this 2 other times. We are literally living through the third time. So yeah, this isn't some well-understood market cycle. Even top economists are scratching their heads a bit.
So here's our game plan. First, we'll break down this investment puzzle. Then, and this is crucial, we'll help you figure out your own investor profile. After that, we'll dive into 3 different expert strategies, tackle the question of how to invest a lump sum, and wrap it all up with some absolute must-know rules to guide you. You see, what makes this puzzle so strange is that it's breaking the old rules of economics. Typically, you have assets like gold and the stock market moving in opposite directions. It's an inverse relationship. When stocks go down, people run to the safety of gold, so gold goes up. But right now, they're both going up, along with everything else. That's what makes 2026 so uniquely challenging. Okay, before we even whisper a word about specific strategies, we have to start with the most important person in the room, you. Understanding your own personal risk tolerance is the absolute foundation of any good investment plan. If you skip this step, you're pretty much just gambling. Generally speaking, most of us fall into one of 3 buckets. You've got the conservative investor, whose number one goal is just not to lose money, capital preservation. Then there's the moderate investor, who's looking for that sweet spot, a balance between growth and safety. And finally, the aggressive investor. They're focused on creating wealth, and they're okay with some big swings for the chance at big returns. See which one of these sounds most like you.
All right, let's get to the good stuff. To help us navigate this tricky market, we're going to break down the recommendations from 3 financial experts, Faraz Aziz, Indra Bir Singh Jolly, and Chanchal Agrawal. Let's see how each of them would build a portfolio for the different risk profiles we just talked about. So let's kick things off with the conservative investor. Remember, the main goal here is safety first, protecting that capital. So if you're looking to play it safe, how do our experts suggest you build your portfolio? Whoa. Right off the bat, you can see some really interesting differences here. Feroz Aziz is actually pretty bullish on stocks, suggesting 60% in large caps. You know, the big, stable companies. On the other end, Chanchal Agrawal is much more cautious, putting 50% in debt. And then you have Indrabir Jolly, who throws in a curveball with a 30% slice for hybrid funds. So the big takeaway here is that even among the pros, there's no single definition of safe. Agrawal trusts the old-school safety of fixed deposits. Jolly, on the other hand, thinks hybrid funds, which are a mix of stocks and bonds, are the key to stability. And interestingly, he avoids gold completely. Meanwhile, Aziz sticks with that classic 10% in gold as a hedge against the unexpected. Okay, let's level up. Now we're talking about the moderate investor. This is for the person who's willing to take on a little more risk to get some balanced growth. And just as you'd expect, that allocation to stocks, to equity, goes up across the board. Farouz Aziz dials it all the way up to 70%, while Jolly and Agrawal landed a solid 50% and 60%. And naturally, as the risk goes up, the allocation to debt, our safety net, comes down a bit. Now this brings up 2 really cool points. First, look at what Indrabir Jolly does. He introduces a whole new asset class into the mix, real estate investment trusts, or REITs, for more diversification. And second, notice Feroz Aziz. He keeps his gold allocation at a steady 10%. For him, it seems to be a core part of the portfolio, no matter your risk profile. And finally, let's look at the game plan for the aggressive investor. If your number one goal is creating wealth, and you've got the stomach for some pretty wild market swings, then this is the section for you. Well, here we go. Equity is clearly the star of the show. Faraz Aziz recommends a massive 80% in stocks. Chanchal Agrawal isn't far behind at 75%. Indrabir Jolly is a bit more restrained at 60%. But look at this. He balances it out with a big 15% chunk in gold and silver. You know, what's really telling here is you can see their core philosophies at play. For Jolly, precious metals actually become more important in an aggressive portfolio, probably as that final safety net against all that stock market risk. But for Aziz, that 10% in gold is a constant. It's a non-negotiable part of his strategy that gives you a baseline of diversification no matter what.
So we've got the strategies down, but let's talk about actually doing it. What if you're sitting on a pile of cash right now and you're terrified of investing it all at once when the market's at a high? Well, good news. The experts have a clear, unified answer for this exact problem. And the advice is pretty simple. Don't even try to time the market. It's a fool's game. Instead, take 25% of your money and invest it right now, today. Don't wait. Then take the other 75% and break it up into 6 or maybe 12 equal monthly chunks. By investing that portion through a systematic investment plan, or SIP, you average out your cost over time. It's a great way to reduce the risk of buying everything at the absolute peak. Okay, before we wrap this up, we need to cover 3 final essential rules. Seriously, think of these as the guardrails on your investment highway. Following them can be even more important than picking the perfect fund.
And it really all boils down to your time horizon. Rule number 1, if you need your money for a goal that's less than 3 years away, a house down payment, tuition, whatever, that money belongs only in debt funds. These are lower risk investments designed to protect your capital. No exceptions. Rule 2, if you're getting into the higher risk world of small or mid-cap stocks, the smaller companies with big growth potential, you need to give yourself at least 5 to 10 years to let that investment grow and ride out the inevitable bumps. And finally, Rule 3, treat gold and silver as a decade-long investment. They can be super volatile in the short term, so don't try to trade them.
So there you have it. We've seen how the experts would navigate this pretty wild market, giving us different roadmaps based on how much risk we're willing to take. They've laid out the frameworks and given us the rules of the road. So the only real question left is, which path are you going to choose?